You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 13th of July, 2023, and I'm rejoined by Andy, who is at Flying Finance on Twitter. I say rejoined, it is the same day, but we have just had a 5-minute break, and now we're back for part 2 of the interview. Firstly, Andy, thank you very much for rejoining us and not just logging off when you had the chance to escape. In this part of the interview, we're just going to focus on your portfolio and some of the stocks in it. So obviously, as mentioned, this is part 2 of Andy's interviews. I would recommend going back and listening to part 1 if you haven't listened to that yet. If you don't want to, that's fine. If you listen to this and enjoy it and then want to go back and listen to it, that's fine. Or if you just want to listen to this, that's fine too. So you've got about 30% of your portfolio in ETFs. You did touch on this in the last interview, but what's the logic behind this and how do you decide how you're allocating between ETFs and what the split is? And do you have anything in mind when you are deciding?
Yeah, so the logic to this is it just provides a bit of ballast to the portfolio for starters. I don't really want to go punching the lights out one year, doing above market returns only to have below market returns next few years. And the COVID rebound had a really, really, really good year. And the next couple of years, I've looked at my portfolio, I'd underperformed a little bit. And I thought that's not really a good reason for me not to have some ETF exposure in there. So I mentioned in the last episode, the few that I hold, the iShares Core MSCI World, that's SWDA, the iShares MSCI World Small Cap, WLDS, the iShares Core MSCI Emerging Market, EMIM. I hold about 20% of my ETFs. So that's half my portfolio. Of the ETFs, 20% is in the world, 10% in small cap, 10% emerging markets. To touch on the last podcast, so just to try and get a bit more exposure outside the US and into developing markets that I see as having better growth potential over the next 10, 15 years. Another reason for doing this, it just gives me a lot of diversification. Can't even remember the number of shares that form the iShares Core MSCI World, but it's something in the order of 4,000 or 5,000. So having my finances spread across all these different companies just gives me fantastic diversification for very, very low cost. I know you did an episode previously where you interviewed a chap about solely investing in low-cost Vanguard ETFs. I think in our heart of heart, most of us know that's probably the easiest way of getting a decent return long-term. I still enjoy investing, so I don't want to go 100% ETFs, but definitely if I'd just got 100% ETFs at the start, I'd be richer now than I am investing in a few of the companies I've invested. So that's part of my logic. Another reason is just to get some thematic and geographical exposure. There's some themes that I will just never be able to understand. One that leaps out at me is cybersecurity. I thought Darktrace looked like a really good IPO a couple of years ago. And if you look at the volatility in the share price, it's just been a bit of a disaster, really. So one that I've got is called iSpy. It's the LNG cybersecurity ETF. It just gives me an exposure to a field of the market I could never do myself. Also, if in that market, you're clearly going to get some winners and some losers. And unless you back the right one, it could be a zero-sum game. You could lose all your money. So it just gives me some diversity. So within the thematic stuff, I've got cybersecurity one. I've also got an LNG clean water fund, so GLUG, GLGG, and I've got a RISE Sustainable Future of Food ETF. Those are all actually in my daughter's portfolio predominantly. More for the fact that I think most of those are themes that are going to continue over generations as opposed to short term. My daughter's still a long way off going to university, so clean water, I can see that being a theme that will run and run and run really, so I'm quite happy with that. And then the fourth one I've got for a theme is the US Dividend Aristocrats, SPDR. That invests in, as the name suggests, companies that have had very strong dividend growth over many, many years. Realistically, I couldn't create a portfolio of those companies anywhere near as cheaply as just buying the ETF. It'd be a lot more work as well. So I'm quite happy just to hold the ETF and leave it there.
Do you think about your geographic allocation when looking at ETFs? Yeah,
a little bit. I'm very lucky that I travel every single week of the year for work. So I do get quite a lot of first-hand exposure to a lot of countries. That's both good and bad. Sometimes I go to places and read the articles ramping investing in them. One that springs out to me really is Turkey, which had a fantastic start to the year so far. I'll probably go to Turkey once or twice a month, and on the ground, it doesn't feel as prosperous as the share price and the indices would maybe suggest. They've got very high inflation. They've done very little to deal with that. They've got quite a lot of poverty. Also, the earthquakes that have happened then last year don't just apply to the areas on the east of the country. There's big concerns about Istanbul. So that's kind of held me off investing. Same with Mexico. I was there earlier in the year, visiting the country. It's an amazing place, but it doesn't jump out to me. It's a great investment opportunity. The only one I have really gone for is Vietnam. I've put quite a lot into VNH Vietnam Holdings, which are funds out there. When you look at the demographics of Vietnam, I think the average age of the population is something like 28 or 29. A very, very low percentage of the country currently has access to even a motorcycle, let alone a car. But at the same time, it's developing very, very quickly, particularly with the pressures inside China. A lot of companies like Apple are shifting production away from China and towards Vietnam. It's opening up a lot. Tourism industry obviously is booming over there. So I've got quite a large exposure to Vietnam. I've got a bit in China, not masses, maybe 1% or 2%. But with those, I've tended to go more down the fund route, partly because I don't think there is a Vietnam ETF, or certainly not one when I looked for it. And also just to get a bit of expertise, I'm happy to pay another 1% or so for some local expertise in those markets to decide on the investment decisions for me.
Why do you like Supreme as an investment? And I should say that I am biased with this one because it is one of my largest holdings.
Yeah, so Supreme, I think I started buying Supreme about a year ago, maybe just over a year ago. So it's right up at pretty decent prices and around the £2 mark, and it's now around the £1 mark, which is very disappointing. There's a couple of things I really like about Supreme. It's not founder-led as such. I believe it's the founder's son, Sandy, that now runs the company. He's got a big stake in the company. We touched on this last week. Could view that as a positive or could view that as a negative, but I certainly like the fact that he's a young chap. He's very, very ambitious, very driven, very motivated. When you look at the boardroom to a lot of UK companies, he is definitely different in demographic, both in terms of his ethnicity and his age to a lot of boardrooms, and that's something I really, really am keen on. It's also his dad's company, so you're going to hope he's going to run it very, very well, and certainly from what I've seen, he does run a tight ship there. It seems like a well-run company. It's got a decent PE at the minute. It's forecast around 4%-ish dividends. It's been growing the earnings per share at about nearly 20% over the last 5 years. I think they had a bit of a hiccup a year or two ago where they were carrying quite a lot of stock of light bulbs and the like. For those who don't know, Supreme are a wholesaler of light bulbs, batteries, and vaping products. And a lot of their customers stopped buying because they were overstocked, and that led to a bit of a correction. I think it dropped about 15-20% as a result of that. And they've been in the doldrums for a little while. But I saw an interview with Sandy a few weeks ago. He said a very interesting thing, quite acquisitive. They go out and buy a lot of companies. And they said when they go in and look at these companies, all they're interested in is the gross profit of those products. Because when they take those brands on board, the same salesperson will go to Asda and Sainsbury's and B&M and sell them. They strip out all the overheads. They just merge those businesses into their existing supply chains and their existing sales forces. And really, they don't pick up any overhead costs associated with them. So a very tight ship. I think they've got quite good potential to grow. They've launched a vitamins brand. They've got like a healthy snack brand. They've got a protein powder brand. Just a very interesting dynamic company that when I look at a PE forecast right now, stock leader 8.6, just seems a bit unfair to me. I think it's got good potential to grow from here.
What interview was that with Sandy? I know the July presentation is out. I haven't watched that yet. Was it a different interview or was it that?
Yeah, I've got a feeling it was the Vox Markets one he did with Paul Hill. It would have been about 12 weeks ago, I guess. Again, I'll put that on my Twitter if anyone's interested in seeing. It's just a 10-minute or so interview, but it's very good. I think as well, they're tainted by the vaping side a little bit. No one wants to touch vaping companies at the minute. They have the benefit of not being a tobacco company that are also offering vapes. So when the NHS come looking for a supplier to offer vaping products for people that currently smoke, which they are doing, I think that's a good selling point for people like Supreme. They don't have this slightly negative history of having supplied tobacco like some companies and then transiting into vaping products. Supreme are somewhat cleaner than that.
Why do you like Hypnosis Songs Fund as an investment?
Yeah, it's not a big position for me. Couldn't tell you offhand what it is, but less than 1% for sure. I'm definitely looking at topping it up at some point soon. So for people that don't know, it's a fund that buys royalties for artists' back catalogues of music. So they've got Rihanna, they've got some of Justin Bieber's stuff. They've also got much older catalogues from artists that are either nearer retiring or have actually retired. And they buy those catalogs. Back in the day when someone recorded an album and sold it, most of their sales would be in the first month or two. They'd get all their money from it and they'd go on and record the second album. Now the industry is much more towards streaming. So someone like Justin Bieber might record an album and get very little money from it because people are streaming over 10, 20, 30 years. That income takes a lot longer to come in. So a company like Hypnosis will come along, offer them a cash sum for their rights to that song. The artist will get their money immediately and Hypnosis will take the income. They're a really interesting company. They do some fantastic stuff. The bear case for it is that the valuation of their back catalogue is extremely subjective. If you take a Mariah Carey track from 1990 or so, how do you value that? How do you put a price on that? So to date, they've been using a discount rate and looking at historical income from the tracks. They discount everything at 8.5%, which seems fairly reasonable to me. But as I sit here now, they're at a discount to NAV of over 50%, which seems quite harsh. Currently, they're yielding about 7%. They do some really interesting stuff. So if a film director comes to them, they'll say, we're looking for a song that will fit into this scene in a movie, and Hypnosis will suggest something for them. And that really has two effects. Firstly, it can provide a lot of exposure for an artist that maybe hasn't been in the headlines much recently. Just thinking of Kate Bush from Stranger Things on Netflix. One recent, in fact, today, RNS from Hypnosis, they went into a couple of their songs. So they own quite a lot of Rihanna's back catalogue. They got 4 of her songs from their back catalogue in the Super Bowl. The following week, streaming of that increased 280%. And 4 months on, some are still 50% higher than they were pre-Super Bowl. So they're a very interesting company. They've got a big database of songs and they've got a lot of data on how many streams there are and how they can put those songs out in the wider market and then increase your exposure and get more income from them really over the long term. So they do songs in films, they do songs in advertising, and they also earn royalties for songs when they're played on the radio and the like. Also this week, they've just appointed a new non-exec, Cindy Rampersaud. She's a board member of the Chair of Audit and Risk for the UK Health Security Agency. So they're clearly trying to ramp up their investment in staff that really understand risk and valuation, because the FT did a big article in probably about 2 years ago, 18 months ago, questioning their techniques of valuing the portfolio. And that's really what's put them in this current negative position. I'm quite optimistic about them. Looking at 7% dividend yield, it's very diversified from equities. I don't think people are going to stop streaming music. They're in the rights to these songs in perpetuity. So it's one I'm very keen on. And looking at the price at the minute, I might top up at some point soon.
So we have looked at it once before. We covered it, I think it was probably about 2 years ago on the show. And the issue we couldn't get past is, like you say, how do you actually put a value on these songs? Because in reality, I know you can try and estimate, but you've just got no idea. Like, even if you look at, you don't really have any kind of historic trends because, like you say, streaming's so new. It's very hard to, if you go back to, say, the 80s or the 90s, how many of those artists actually stuck at it until 20 years later where people are playing them. I know there's somewhere it's like Rihanna where I just think in 20 years time people probably will still be playing Rihanna to at least some degree, but for a lot of them you're buying a song and in 5 years time you might have no one listening to it. That was our issue with it.
Yeah, and that is a concern. What Hypnosis will tell you is they've got a lot of data on the age of the song and the age of the average listener, and they'll compare those. And I think in the RNS it touched on a few songs that are performing really, really well, even though some of them are 30, 40 years old. It does take a bit of a leap of faith. I think that's certainly a fair thing to say with it. All I would say is that a 7% dividend yield on a fund that's not in any way at all related to wider equity valuations, that seems like a fairly good return to me. But I think it's probably still got a little further to go before they reassure investors about how they value them.
With that 7% dividend yield, what's that paid out of? Is that just paid out of the royalties that come in? And do they have, presumably they've got a load of debt that they took on to acquire the rights to the songs?
So looking at the current figures, right now, dividend yield 6.95%. To me, it's not a scientific way of doing it, but I'd say if they're making enough profit to cover a dividend yield of 7%, that would give a fair indication of what the portfolio is valued at. 2022, they gave 7%, 6.5% on a trailing 12-month basis, and then it's 6.95% the next couple of years is forecast. In terms of the debt, they are quite high in debt. Actually, it's about $500 million of debt versus a market cap just under $1 billion at the minute. But looking at the debt price, it's been in the doldrums for quite a while. It's traded between a range of about 80 or 90p. I dropped a little bit recently down to 74. So I probably won't add for a little while, but it's definitely one I'm interested in adding a bit more to in time.
So how much are they paying in interest every year compared to how much they're paying out in dividends?
Yeah, that I don't have to hand, actually. I'd have to dive into their
Because
account
that
to
would
get
be
that.
my biggest concern with it. I'm not concerned about in the next few years. I mean, in the long term, I wouldn't, like I said, we would really struggle to predict what was going to happen with some of these songs. In the short term, I don't think you have as much trouble predicting them because it's probably going to be quite similar to last year for a lot
Yeah.
of songs. But the issue I would have is my biggest concern with it would be what rates have they locked the debt in at, and what kind of interest rates when some of this debt comes up for renewal. At what interest rates is it a massive problem? Because if it's a relatively new fund and it only came out sort of 2-3 years ago, you're in that time period where interest rates were at rock bottom.
Yeah.
So when they renew, does that just absolutely hammer the dividend?
Yeah, potentially. And actually looking at dividend cover on this one is for 2023 estimated dividend cover of 1.03. So they're only just covering the dividend. There was some talk, I don't know if it came from Hypnosis themselves or just chatter on the forums. There was some talk about them selling off some of their portfolio, partly to help them recapitalize a small bit, but also that would give a strong indication to the market that their valuations are correct. If they say X, Y, and Z, a song is worth 5 million quid, and then they could sell it for £5 million to one of their competitors, that would give you a strong indication that they are actually accurate on some of their assumptions.
Would it though? Because if they're selling it to a competitor, presumably they're doing similar things themselves. So, if they're just selling it to other companies doing the same thing, is it almost like the art market where it's like, do you know what I mean? There's not really any actual substance behind it. It's just what someone's with. I know any valuation, you can make the same argument, but it is very, very difficult. Whereas if you've got two companies that they basically just go out and buy the rights to songs and they buy some songs off each other, I wouldn't then be like, oh, well, I guess the valuations are fine.
Yeah, it's a fair point. I guess the counter argument is you could say, well, if they've bought it for a price 2 years ago, and the industry as a whole of song royalties and all these companies have had a bit of a tough couple of years, if they can sell it for what they've got it listed as on their balance sheet, that's probably a good indication that the industry as a whole thinks that these assets are still worth that. I know what you mean. It is ultimately, it could be viewed as a bit of a Ponzi scheme. It's only worth as much as the next person's going to pay for it. But equally, I feel like if their competitors are willing to take on more risk by buying these assets, it's probably a good sign that the market as a whole is fairly optimistic, even if that is a bit of an insider view on it.
Why do you like Wix as an investment? And I should stress this is WICKES listed in the UK, not WIX listed in the US.
Yeah, so Wix I bought not that long ago, probably about 3, maybe 4 months ago. So for people that don't know, it's a DIY chain in the UK. It was part of Travis Perkins, and then it was spun out of Travis Perkins around start of 2021. So it floated at 250, and it's sat at almost exactly half that today, as seems to be the trend with a lot of IPOs. There's a few things I really like about Wix. They are trying to change the business quite a lot. So historically, it was viewed as a bit of a rough and ready builders merchants, maybe. They're trying to trend towards they call it a do it for me movement, a bit like Howden's, where they'll sell you a kitchen and their fitter will do it, but ultimately it's them doing it for you. So they're trying to get into that a lot more, both with kitchens and with bathrooms, which seems like quite a popular trend at the minute. They're also quite differentiated from people like Screwfix and Toolstation. When you go into Screwfix and Toolstation, you obviously can't buy larger items like timber, plasterboard, cement, masonry products. They're a trade counter type business model. So they're quite differentiated from those businesses. And they've done a lot of investment in their click and collect service. So builders on their way to Travis Perkins can choose what items they want for the day's work. When they get there, open the van up and the Wix staff help you load it into the van and off you go. So that's something that Screwfix and Toolstation can't do. And also, having dealt with Travis Perkins in a previous life for 10 or so years, you can waste an hour in Travis Perkins getting the stuff you need, whereas Wix is very quick getting the stuff on. Another thing I like about Wix, we touched on it earlier, they've got quite a lot of cash on the balance sheet. So at the minute, they've got 165 million on the balance sheet and the market cap of 300 million. So it seems quite cheap to me. It's always a little bit tricky with these companies that are spun off when you look at their earnings per share and revenue. You do have to take a bit of pinch and salt because they were previously part of Travis Perkins Group. How reliable are the figures that are out there? How do they account for purchases internally? But nonetheless, if you take their figures at face value. They've got revenue growing at 8.5% per year CAGR. Earnings per share, this is the one I do have some concerns with the validity of, but allegedly growing at 45% a year. And then it's also just a very, very cheap company. So the forecast PE on Wix is 5.4 and a dividend yield of 8.45. It just seems very cheap to me, really. They have got a bit of debt. I think a lot of that is leases rather than actual financial debt. If you strip out the cash from the balance sheet, it's an incredibly cheap company, really, that seems to be trading quite well. Also, if interest rates creeping up, maybe that'll put people off doing DIY. It will almost certainly put people off moving house. That could both be a negative, that people move into a house and they like to do building work on it. But also, if people are staying in their current homes longer, they might be tempted to put in new kitchens, new bathrooms, do decorating work, and do just general home improvements. I don't think it's a perfect company by any means. I think with the valuation and the cash they've got, it's a very interesting company indeed.
I think just touching on the valuation, we've never covered Wix on the show. We have covered Kingfisher, which owns B&M, and they're also incredibly cheap. So I think they usually trade at P of about 8 or something like that. So I would say it's partly probably an industry thing. Also, with the PE growing, not the PE, the earnings growing at 45% a year. If Kingfisher's anything to go off, they had an incredibly good COVID period because everyone was locked down doing the home improvements. So I know we're getting to the point now where the COVID figures are more than a year ago, so they're no longer the comparatives. But if you look at like the last 3 years figures for any of these like sort of DIY companies, they're going to be fantastic. And I don't think, I almost think if there's a time to spin out one of these companies, it was in the last year or two, because you're going to have the best ever growth figures. So yeah, but then if you're getting a decent dividend and it's well paid and stuff, it doesn't need to be growing at 45% a year.
Yeah, that is a good comparison. So we have got a tiny bit of Kingfisher in my wife's portfolio, very, very little of it to be honest, but just for comparison. So Wix is on a PE forecast of 5.4 with a dividend yield forecast of about 8.5. And Kingfisher's on a PE of 9.2 with a dividend yield of 5.1. So you're getting, Wix is basically half the PE ratio of Kingfisher, and the dividend yield is about 3/4 again what Kingfisher's is. So even against Kingfisher, it does seem fairly cheap to me. Appreciate Kingfisher is a bigger business and maybe has a bit more history that account for that, but still seems quite cheap to me, Wix.
Why do you like SCS as an investment? Speaking of cheap businesses.
Yeah, I mean, as a company, when I go into SES, I do look around and question why I hold it. I'm not a big fan of their products at all, but again, it's incredibly cheap. I'm down quite a bit on SES, but it does look like it's maybe starting to find a bit of a floor. It's currently about 145p a share. So I thought in SES very similar to Wix, if I'm totally honest. The PE is low right now today, PE of 8.9 going forward. Earnings per share growing at 6.7%. It's actually quite interesting if you look at the revenue for SCS. It literally hasn't moved since 2017. So if I look at 2017 figures, 333 million. If I look at 2022 figures, 332 million. So their CAGR over 7 or so years is 0.084%. It's not growing in any way, shape, or form. So you definitely don't go into this one for growth as such, but the earnings per share are growing. So they're clearly doing something right internally. It's got a nice dividend yield at the minute, forecast 9.34%. It's doing lots of share buybacks, so that should help things out a lot. And again, it's got loads of cash. I know you've covered this on the podcast a couple of months ago. It's got £75 million of cash on the balance sheet. Some of that is customer deposits, but it's not as much as you might think. 75 million of cash, and market cap today is 50 million. And then if you look at the competition as well, DFS are in a pretty bad way. They're taking on lots of debt. They're still giving off a huge dividend, but they're using debt to fund it. So it seems to me like DFS is in a pretty bad spot, really. But SCS is just carrying on steadily and giving dividends, and it's very, very cheap.
Why do you like Tesco as an investment?
Yeah, Tesco's one that's maybe going to be leaving my portfolio at some point soon. I bought this one quite a long time ago, 2017, I think I bought this one. It was right around the time they had a big accounting scandal and the shares got absolutely smashed. And every day I'd go into Tesco and it'd still be full of people and the revenues were still constant and people just didn't want to hold it. So when I bought them, they're about 180. I think they're close to 250 today. Yeah, they almost hit 250 today. They've also given a lot of special dividends over that time, so that's been really, really nice. It's a bit of an inflation hedge with inflation on food at 17 odd percent. Tesco seems like a decent place to be. It's paying a 4.5% dividend, which is decent in the market. That all being said, I'm not that excited by Tesco's, if I'm honest. It's just in my portfolio because it's always been in my portfolio, really. And it's one I'll probably look to exit at some point in the next year or two. It's just finding a chance to exit it, really. There's nothing wrong with it. It just doesn't really fit there anymore.
Why do you like Burberry as an investment?
Yeah, again, a fairly small position. I think about 1.5% of my wife's portfolio we've got in Burberry. Held it for pre-COVID, I think we bought that, or maybe just in the middle of COVID. The thesis was with that, fairly obviously, luxury retailers are, in theory, slightly more recession-proof than general consumer retailers. It's been disproven a little bit. The figures out of China recently about luxury spending haven't been the most positive. Burberry, I think their sales were down slightly on the last RNS that came out a few weeks ago. That being said, it's still fairly cheap. For a luxury retailer, it's on a PE of 16-ish, which doesn't seem excessive to me, really, for a luxury retailer. For comparison, LVMH are at 30, so virtually double what Burberry on. They're paying a bit of a dividend, 3% or so. And I know you shouldn't invest for that reason, but I do feel like they could be a bit of a takeover target. There's not many luxury retailers left in Europe that haven't been hoovered up by LVMH. Similarly, Fraser's Group, what was Sports Direct, they seem to be buying everything going at the minute and taking positions in some luxury companies as well. So given it's on half the PE of LVMH more widely, it just seems like quite a cheap company at the minute. But again, it's a bit higher risk. I don't know where the sales are going to go over the next couple of years.
How do you think the Burberry brand compares to the LVMH brands?
It's definitely got a lot less diversification. You know, LVMH has got fashion, they've got alcohol, they've got so many brands, they're spread all over the world. So definitely you are backing a bit of a one-trick pony with Burberry. That being said, they changed their creative director. I think it was the spring of this year, they got a new creative director in. So that's encouraging. Normally when new people come in a role like that, they want to make an impression, they want to launch some new designs. So that could help things out a little bit there. Definitely the safer bet will be LVMH, but you are paying up for that.
But how would you, if we compare, say, Burberry and Louis Vuitton as brands, I just feel like Burberry is a good brand, but it's not Louis Vuitton.
Yeah, you're true. So when I walk through the airport every single day in my terminal, we have a Burberry branch and we do have a Louis Vuitton branch. And you see a lot more Louis Vuitton bags on our flights than you do Burberry bags, which is a little bit disheartening. That being said, you know, Burberry is a British staple. It's got a good history behind it. It's got a good story. It's got classic designs that are somewhat more timeless. So hopefully a new director can inject a little bit more of that personality into the company. But I won't argue that Louis Vuitton is definitely a cut above Burberry at the minute.
Why do you like Avon Protection as an investment?
Yeah, I don't really like Avon Protection as an investment. It was an absolute disaster for me. So I bought this one about 3 years ago now. And it was one of those shares that had been widely covered for private investors. It was very, very popular. It performed fantastically. It had a couple of orders that were delayed from the US Department of Defense, I believe it was. And the share price just went off a cliff. It dropped by about a third, maybe even a half over a very short space of time. And it started trading in a range and it started improving. And I thought, you know, it's a really good company. It wasn't particularly highly valued back then. It provides ballistic headgear and rubber masks for deep sea diving and police diving and stuff like that. So it's in a real strong niche where they've got these products that are life critical, that are bought in big contracts from governments that are fairly predictable in their spending. But unfortunately, ever since then, they've had so many issues. They bought a division that did body armor, which then promptly failed a whole load of tests for US Department of Defense. That made the share price drop some more. So really, it's one of those shares that I wish I got out of a lot earlier. I'd say being optimistic about it, they have won a few new contracts recently. There has been a bit of positive news flow. They seem to be moving sideways a bit rather than moving down, which is quite encouraging. They do pay a bit of a dividend, which is quite nice in this market. I'm quite keen on a bit of dividend. So there's a few things to be positive about there. And also it does give a bit of defense exposure without buying arms companies and other companies that maybe there's some more ethical concerns about. It'd be very easy for the US government to buy a lot of Avon's products and donate it to Ukraine. It might be more politically contentious as we've seen in the last week or two, if they're supplying cluster bombs and the like. So I think Avon's a bit of an interesting one. I definitely wouldn't recommend it as a share given my experience being in Avon. And it was actually Avon that made me look a bit more closely at using moving averages to time entries and exits, because I'd have saved a lot of money on this one had I done that. But I still think there's some optimism there, if I'm honest, but it's not my favourite share by a long stretch.
If you didn't own it, would you buy it again today at the current valuations?
No, which I probably should sell it on that basis, but it is difficult when you buy a share that's 1% of your pension and it then drops to 0.5% of your pension. You think, is it really worth taking that money off the table? But I probably should, yeah.
What would the art of execution tell you to do?
Well, art of execution, I'd classically be a rabbit on that one. So the idea that you're kind of stuck in the headlights and you don't know which way to go. What you want to be ideally is an assassin, where you take out these bad shares as quickly as you can, really, which is something I've failed miserably to do in this particular case.
I think when it comes to selling, I'm definitely a rabbit.
Yeah, which comes back to what we chatted to in the last episode. I think most investors would consider themselves better at buying than selling. So for me, you can either get better at selling, or you can work on buying shares that you hopefully won't need to sell. And that's the strategy I'm going for at the minute, trying to buy stuff that I might still be holding in 10 or 20 years, but I don't have to have that difficult decision.
So you've got Haleon in your portfolio. You've also got GlaxoSmithKline, so I'm assuming that's where Haleon came from.
That's correct.
Why did you decide to hold on to it after it was spun out?
Yeah, so one of the articles I read around the time about the Haleon spin-off was in Shares Magazine. Again, I can post a link on my Twitter to it. It's called GSK and Haleon, why the spin-off can be more an interesting part of a demerger. So there's quite a lot of academic research that suggests that spin-offs generally outperform the parent company after they've been spun off. The figure they gave was an outperformance of 20% over the first 3 years that it spun off. So that was really why I held on to it. Also, like for a lot of this stuff, it's such a small position that, selling it almost becomes pointless, really. I don't think Haleon's a bad company by any stretch of the imagination. They're putting a lot of work into trying to develop new products. The last RNS looked like they were putting a lot of effort into keeping up with inflation and trying to increase the selling price of their products, which was quite positive. Revenue's growing all right, earnings per share are growing all right. Probably won't top it up, but I do keep an eye on it. I may at some point.
What do you think of the whole Unilever GSK incident, for want of a better word, where they tried to buy it for 50 billion? Because you own Unilever as well.
Yeah, I do own Unilever.
Where were you? What were your thoughts as this was unfolding?
I don't think there's a single person involved in that process on either Unilever side or GSK side that comes out of that decision looking good in any way, shape or form. So if Unilever genuinely thought that 50 billion was a fair valuation for that company, they should be buying it now when it's got a market cap of around about half that, just over half that. That's the bargain of the century. They dodged a bullet. If they thought it was worth 50 and now they can buy at half price, they should be hoovering up, but they're not, which is quite telling. At the same time, GSK floated a company that they were offered 50 billion for and cost their shareholders quite a lot of money by the fact that it's now worth half that. So I don't think anyone looks good out of that. There's not really a positive you can take from it on any side.
What would have been your ideal scenario as a shareholder? Both.
I don't know. It's just such a mess, isn't it? It's,
Maybe if they just never offered and you didn't know
like
what you could have
picking
had.
your favourite child. There's just, that would probably be the ideal scenario. No one make a stupid offer.
No one rejects it.
Yeah, no one rejects it. It's almost like no one ever wants to talk about it. It's just like those mistakes you make in your private life that you never chat about ever again. You just pretend it doesn't happen and move on. I feel like it's one of those just on a £50 billion scale.
Why do you like British American Tobacco as an investment?
Yes, I've just actually topped up British American Tobacco this week. So bought them when they were at a low just over a year ago, I think that was. Yeah, tail end of 2021. So they held it for about 18 months. They were about 25 quid a share back then, and the forecast yield on that at that point was about, I think it was just north of 10%. Obviously, there's big ethical concerns with buying tobacco companies. My personal view is that the risk of tobacco is very, very well publicised. I don't believe in telling people what they should do with their health or their life decisions. People want to smoke, that's their free will. So I don't have a particular concern of holding it. Obviously, I'd rather they were a nice, green, ethical company, but such is life. You don't always have control over these things. So yeah, I bought it when it was yielding about 10%. It rapidly shot up by nearly 50%. And really, I should have exited then. Again, the moving average would have helped me, but I was a bit drawn in by the dividend yield. But interestingly, they're now back down at £25 a share today. So I topped up a bit more, forecast yield on that, 9.5%. I think what I like with that, a few things really. It's a bit of a defensive play, like people aren't maybe going to cut down on their tobacco consumption just because of a recession. They're going to carry on smoking more or less what they have always smoked before. It's quite an interesting industry in that marketing of tobacco products, not in America, but certainly in the UK and most of Europe, is illegal. So that effectively blocks all new entrants coming in, because how are you going to launch a competitor to any of British American Tobacco's brands without being able to market it? And it also has a big advantage of British American Tobacco in that they no longer have to spend any money marketing their tobacco products. It's got really good yield. Morgan Housel talks about this idea that if human beings have done something for many hundreds or even many thousands of years, they will probably still be doing it in many hundreds or many thousands of years. And, smoking predates every single person on the face of the planet. It's remained very popular even when people have learned that it's caused cancer. So I think people will carry on smoking. They're still growing the company. Their sales are growing at about 7%, price earnings 6.6. It's very cheap, and also growing revenues from non-combustibles. It's 15% of their revenue at the minute. They're trying to target 5 billion by 2025, profitable next year. And I think some of their targets are actually brought forward because they've been performing so well. So it's not a perfect company. It's a bit grey in terms of the ethics of owning it. But on a personal basis, I don't have a problem. And I'm ultimately on there for the dividend yield and the fact that it's very, very defensive.
I don't have a problem with it either. I do think in the Western world, at least, everyone's well aware of the dangers of smoking. I don't see what more they could actually do to make anyone like, if you get to 18 and you're not aware that smoking is dangerous, I mean, it genuinely isn't possible. So yeah, so I do like it. I have been having a look at it recently, actually, just because it is so cheap and that dividend yield is so good. And you just look at it and it's kind of like, well, they are like clockwork. I know they've got the volume drops, but they are increasing the revenue. They're still increasing prices year on year. Yes, they've got a smaller and smaller pool of smokers, but at 10% yield, it's like, realistically, you need this company to last, 10 years and you've got your money back? It's probably less than that, because they do buybacks as well. So you're actually probably
and if you reinvest it as I do, you're probably talking near 5 or 6 years to get your money back.
Like, will people still be smoking in 5 years' time? I don't think it's going to be that different. You need some really radical legislation to come in. I'm sure it would drop, but even if they started bringing in more legislation like they've got in, is it New Zealand, where it's like,
it is.
They banned it so that it's like the new 18-year-olds that come in can't smoke, but the existing over 18s can. But even then, I think you'd probably expect it to drop more, but at the current valuations, it would take a generation for that to actually kick in. So it'd still be attractive. So it's, apart from an outright ban, I think it's just so cheap that it's hard not to get your money back on it.
Yeah. And as I say, they are growing sales, but even if you hypothetically said all these bans come in and their revenue drops by 10% a year in perpetuity, it would still be fairly cheap. I'd probably still hold the shares just for the dividend. And there's lots of companies that are in dying markets. I think it's Smith News that deliver newspapers to retailers. That's clearly in a dying market. I can't see us still reading physical newspapers in 10 or 20 years' time. But equally, you've got a managed exit out of that industry. And if you've got any idea of when it's going to finish, I think Smith News is on a crazy PE at the minute and very, very cheap indeed. You only need it to be a few years and you get your money back, and everything else is a bonus, really. So that's my idea with that. If you look at their share price chart as well, they seem to bounce off £25 a share. They did it once in 2019. They did it once in 2020. They did it, in fact, about 3 times in 2020, 2021, and now they're back down there in 2023. So I topped up purely because it seems there's a lot of support there at £25 a share. They always seem to bounce up from that point, not always by a lot, sometimes just a few percent. It does seem like quite a good entry point to me.
Yeah, and as well, I do think tobacco. We talk about it fairly regularly on the show anyway, but you've also got the next generation products, and they do seem, especially the British American ones particularly, do
Yeah,
look quite encouraging. So it does seem to have some level of a future as well, and it's the way it's priced, it doesn't even need a future.
yeah, absolutely.
What was the other company that you wanted to cover?
Capital, CAPD, CAPD.
So what do they do?
So Capital, they work called Capital Drilling. They are UK listed. I think their head office is somewhere very random like Mauritius. But they are an African company that supply equipment to mining companies is the short answer. So they provide drilling rigs to open up mines. That's their bread and butter that they've been doing for a long, long time. But they're now starting to expand into other markets that are directly related to that. So they've got a division to the business called MSA Labs. They provide this X-ray machine. It arrives on site in 3 porta cabins, and you can take samples from the ground and run it through this X-ray machine. It's an extremely strong X-ray, and it finds out how much gold is in your samples. So they're a growing company. They are headline growing revenues at 20% a year, earnings per share growing at 23.5% a year. With all their plants and everything else and the cash on the balance sheet, price to book is about 1. Not a fantastic yield, but it's enough, 3.6%. But it's the MSA Labs that's the real gem in this one. So it reminds me a lot of Airtel Africa with their payments app. You know, you've got this big company that people know for telecoms, but they've got this little side project that could actually turn out to be more profitable and more interesting side. And that really is how Capital looks to me. So this is one of Mark Simpson's favorite shares. So the MSA Labs grew 75% in 2021. In 2022, it grew 74%. It's growing extremely quickly. The drilling supply operation was incredibly profitable. A good list of very well-known mining companies in Africa. And now with the MSA Labs, they're putting labs. They just opened a couple in Canada and I believe one in Australia as well. They're high margin. They're very specialized. They're marketing these to existing customers. So it's not far away from their original business model. It's like they're going to something way off piste. And then I think it was just yesterday, they announced a joint venture with a company called the joint venture was with Enaware, and it's called Mine Power Solutions. So the next side to the business that they're going to be looking at is supplying solar panels to mines. Obviously in Africa, you've got a lot of problems with the reliability of power grid. When you have blackouts going on, these mines can just shut down because they've got no lighting, they've got no air conditioning in the accommodation. You can have some parts of Africa where mines just close for days on end and can't do any work. So Capital has done a joint venture. They're going to be selling or leasing these solar farms to mines to keep the power on a bit more. It's a very, very cheap company. Price earning of 6, dividend yield of 3.5%. It's just growing very, very quickly. There's a lot of videos on YouTube, interviews with the CEO. Again, quite a young guy, seems very motivated to grow the business. There is a comparative company that are listed in Australia with price earnings much, much higher than this particular company. Obviously, the exposure to Africa is holding the valuation back a little bit. There's a lot of people who don't want to go near that part of the world. And there's also a lot of people who don't really want to touch the mining sector. But this is a bit more resilient in that a mine will need to be excavating, even if the gold price drops. So it's a bit insulated to movements in the precious metals market. It is generally gold mines that they seem to work in. It's just a very interesting company, growing quite quickly, lots of different parts of the business coming online and very, very cheap.
What's the ticker for it?
That is CAPD, CAPD. So it's Capital as opposed to Capita, the financial company.
Is it UK listed?
Yeah, London listed, and they're 90p today. Most of their accounts are published in US dollars, but UK listed. Couldn't tell you which market. I would assume they're on AIM. But,
so what does the company, what was the other company? What does that do? The one that's inside it?
So MSA Labs, it's an X-ray that works out
so that's just the
how much
X-ray
gold
bit.
you've got. Yeah.
Okay.
I think they only launched it about 3 or 4 years ago. It seems like a very popular product based on the growth rates they've got from it, and the fact that they're establishing into more established markets like Canada and Australia, as opposed to most of Capital's operations are, I believe, still in Egypt. Just one I thought you might be interested in. It's got a lot of similarities to Airtel, as I say. In fact, when you look at it, it's very, very similar, just in a totally different market. Geographically,
Yeah.
very similar.
I'm going to make a note. I've added that to my watch list, so I'll cover that on the show at some point. It's
It's quite
definitely
a
worth
good
a
one.
look.
Yeah, it's just quite
anything
a
with
simple
that
business.
anything with that kind of growth and a PE of 6, it's always worth taking a look at.
Yeah. The drilling's growing, not fantastically, but it is growing. But it's the MSA Labs is the real hidden gem in there that could be quite transformational for them, I think.
No, I'll definitely have a look at that. So thank you very much. Was there anything else that you wanted to discuss before I wrap it up?
Yeah, I've got one question for you guys. I was just curious about, given the volume of shares that you cover on an episode by episode basis, how do you personally keep track of your notes? How do you journal it? If you've got any top tips, because that's something I'm trying to improve on a personal level, is writing more of a journal when I buy shares, when I do research on shares, so I can come back to it. So have you got any tips on how you do that, given the volume of shares that you cover?
I'm not fantastic at documenting, I'm going to be honest. So what we will do is, I think the main benefit of doing the podcast is that I will look at a share usually more times than I previously did before buying it, because I see it every sort of 6-12 months, especially when it's shares that you would just never have looked at otherwise. So what will usually happen is we will cover a stock. So I used to subscribe to quite a few, like, services where they gave tips and stuff. And I wouldn't buy the tips, but I used that to build my watch list. And I'm not subscribed to any of them now, just because I'd got to the point because of the show where I wasn't using them at all, because we were doing that research ourselves. But what we'll do, or what I'll do, is I will cover it. And we're only doing 10, 20 minutes. Well, it's probably not even that. But like, in terms of the actual content, it might be 5 or 10 minutes. And we'll do that 5 or 10 minutes. And obviously there's a bit more work that goes into the background, but it's not huge for this, obviously, for the type of show, because we don't need that much content. And yes, we do miss some bits, but like, I just don't want to spend 2 hours prepping for a company that I'm probably never going to look at again. So like, for a lot of these companies, we'll maybe do 20 minutes of prep each per company. So it's kind of like, look at the results, see what else is going on, find out about the company. And then what it allows us to do is we can do the show with an hour's prep, because we cover 3 each. So if we're feeling lazy, we'll just not look at the other person. We'll just fire a few comments back after they've sort of pitched it, which works quite well. And then even if it's one we like, sometimes we'll just forget about it. So it's not great. And then 6 months later, it pops up again. It's like, oh, let's have another look at that. And then we might like it again. And I've had it now a few times where, like, what I do is when we get to the point where I'm listening to something, and like 2 or 3 times we both sat there on the show saying how great this company is, and I know this is like the 3rd time this has happened. At that point now, I'll be like, well, hang on, why haven't I had a look at this? Because between the two of us, we can't find anything wrong with it. So a good example is like Next or Associated British Foods. Every time we cover them on the show, we just sing their praises. And then I go and look in my portfolio, and there's multiple companies in my portfolio that I like less than Next and ABF. So at that point, that's a trigger for me to then be like, well, actually, I need to do have a proper look at this. So at that point, I will then start going through actually the annual reports and all the results for however long. But I don't really document it. I will just read it. So I'm not a fantastic documenter, unfortunately. The only kind of documentation that I actually do, I suppose in theory, I'm documenting when I record it every week, but I don't then go back and listen to it. So it's not actually useful. The only kind of documenting I do is every year on the 5th of April, I make a list of every asset that I've got and the number of shares and stuff. So I can see year on year what I'm holding, but that is literally the only kind of documentation I have, really. It's not something I'm very strong on. I guess I'm just too lazy, and as well, I sort of know if I really wanted to, I could go back and listen to what I've said 2 or 3 times talking about a business, but no, I'm not fantastic at documenting, so I'm probably not the best person to ask. But there's some people like that Ben Bennett, who we interviewed recently. He's much more into documenting, and he's got that. Do you know Jake Taylor?
No.
So have you heard of Value After Hours, the podcast?
Yeah.
So Jake Taylor's one of the co-hosts of that, and he's recently launched his own app, and that basically it's a journal built for documenting investing decisions.
Oh, that's interesting.
And they've got a free version of it, or it might be free. and then they're going to like introduce paid bits or something like that. But if you just drop Ben Bennett a tweet, so he's at, I think, value_1 pages.
Oh yeah, I follow him already.
Yeah, so if you just send him a tweet, he can send you the link to it. But that's meant to be quite good. When I spoke to him about it, his biggest concern was actually it's so good that it's kind of like once they start putting a paywall on and adding all these extra features you've got to pay for, am I then going to be in a worse position than if I'd kept like a spreadsheet? Because I've now got to pay to not lose my stuff because of how sticky it is. Kind of like you don't want to lose the data. But yeah, that's the only other thing I'll do. Like sometimes, and it's much rarer now, but sometimes I'll make a spreadsheet documenting like what I'm actually looking at. But that's more just like compiling all the metrics in an easy format. So I might go through like the last 10 years of accounts and like just set up a few formulas to calculate the growth. But in terms of narrative, I'm not putting loads of stuff on it.
That's interesting. I just assumed you'd be all over that because you cover so many companies. So it's quite reassuring that.
No, I mean, I definitely sure. It's probably a case of say as do as I say, not as I do.
Yeah.
But yeah, I mean, we do have it sometimes where it's kind of like we've got companies and we'll do them the second time, and we've not covered it for a year, 18 months. It's kind of like all I can really tell you about it is it's like, oh, we quite like that one, didn't we, John? I don't remember anything else. And then, like, obviously, what happens is that I sort of feel like once I get to a point with a company where it's like, I've seen the results once and liked them. When we're going through for the show every week, if they've got results coming out, we will then look at them. So that kind of allows me to be a little bit lazy in that I know that I will look at them again in 6 months.
Yeah.
But yeah, I probably should document more.
Huh. So the only other thing I was going to ask or put out there, we touched on in the first episode the fact I don't read maybe as many investing books as I should. And I think part of that maybe is just laziness on my part, and a bit of peer pressure would probably help with that. So one thing I'd be quite interested in setting up, if any of your followers are interested, is just setting up like a very, very informal book club where every month or two we try and read the same book and maybe have a small discussion about what we thought of it and any ideas that have generated off the back of that. So if anyone's interested in doing that, I'm Flying Finance on Twitter. Just drop me a line. It would just be super informal, and we'll just try and have a variety of books on different subjects, all very easy to read and very accessible and non-technical. If anyone is interested in doing that, just drop me a line.
Yeah, and if you want to just send some tweets and tag us, we'll just retweet it. I don't know how many you'll get, but I do.
Yeah,
think
I'm not sure.
One thing that you did touch on in the first interview is like obviously investing being a solitary activity.
Yeah.
I think one consistent theme when we do these interviews is that comes up a lot, but actually you've got a lot of people that are doing it that do want to talk about it because obviously it's very helpful to get the feedback and stuff, but they've just got no one to talk about it with. I think that's everything in that case. So thank you very much for your time. If anyone does want to follow Andy, it's at Flying Finance on Twitter. So yeah, just thank you very much for your time. I've really enjoyed recording this, so hopefully you've at least found it bearable. But
no, it's been good. Thank you very much for having me on. Thank you for everything that you do with the podcast. It's a very enjoyable listen every week, and your work's much appreciated.
Thank you very much. So thank you everyone for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.